Okay, so you want to own a gym. Rows of gleaming equipment, members filing in before dawn and after work. A business that seems to run itself once people sign up. Collecting a modest monthly fee from thousands of people who mostly just need somewhere to lift weights and run on a treadmill. You picture yourself as the neighborhood fitness entrepreneur, the person who turned a passion for health into a steady, recurring paycheck. That's the fantasy. Here's the actual business hiding underneath it, an industry that was quietly built, for decades, on a business model that depends on a large share of paying members never actually showing up. Where the entire math of a low-cost gym only works because most people who sign up in January stop coming by March while continuing to pay anyway. And where the same square footage of real estate can represent either one of the most reliably profitable small businesses in America or a money-losing trap, depending almost entirely on a handful of decisions made before the doors ever open. Some gym owners have built genuinely durable, multi-location fitness empires worth tens of millions of dollars. Others, including operators of nationally recognized chains, have gone bankrupt multiple times over, done in by the exact same real estate leases and equipment financing. That seemed like a safe bet when times were good. By the end of this, you'll understand exactly why gym ownership is one of the strangest businesses in all of consumer retail. A business that is often more profitable the less its own customers actually use it. What you're actually buying before the money makes sense. You need to understand that gym describes several genuinely different businesses that happen to share the same basic layout of equipment and mirrors. The first, and the one most people picture, is the low-cost, high-volume gym. The Planet Fitness style model, built around an extremely low monthly membership price, often under $15 a month, designed specifically to maximize the total number of members, regardless of how often any individual member actually shows up. The second is the mid-market full-service gym, charging $40 to $100 a month for a broader set of amenities, group fitness classes, more extensive equipment, sometimes a pool or basketball court, competing on the completeness of the experience rather than pure price. The third is the boutique fitness studio, the CrossFit box, the cycling studio, the specialized yoga or pilates practice, charging considerably more per visit or per month, often $150 to $300 or more, in exchange for a highly curated, instructor-led experience and a genuine sense of community that low-cost gyms don't attempt to replicate. And the fourth, increasingly significant model is the franchise structure that underlies many of the largest chains in every one of these categories, where the actual gym is owned and operated by an independent franchisee who has paid the parent company a substantial upfront franchise fee and ongoing royalty in exchange for the brand name, the training systems, and the negotiated equipment and supply relationships that an independent gym owner would struggle to access on their own. These are genuinely different businesses with genuinely different economics. Since a low-cost gym's entire model depends on selling far more memberships than its physical space could ever accommodate if everyone showed up at once, while a boutique studio's model depends on the opposite, a genuinely limited number of members who show up frequently enough and pay enough per visit to justify the higher per square foot cost of delivering a more personalized experience. The breakage business model here is the single most important and most uncomfortable fact in the entire low-cost gym business, and it explains almost everything else about how this specific segment of the industry actually makes money. According to industry analysis of gym membership utilization, a low-cost gym charging a monthly fee typically sees only a modest fraction of its total paying membership actually visit in any given month. And the industry has an internal term for the resulting gap between memberships sold and memberships actually used: breakage. The same term insurance companies use for gift cards nobody redeems or policies nobody claims against. This is not an unfortunate side effect the industry tolerates. It's the deliberate, foundational economic engine of the entire low-cost gym model. A facility physically sized and staffed to comfortably accommodate perhaps a few hundred simultaneous users can profitably sell several thousand. Membership specifically because the overwhelming majority of those members, particularly the enormous wave who joined with genuine New Year's resolution enthusiasm each January, will stop showing up within a few months while continuing to pay the modest monthly fee out of simple inertia, forgetfulness, or the sunk cost hope that they'll eventually return. This dynamic explains the specific, almost aggressively low pricing strategy that defines this entire segment. Since a price low enough that canceling barely seems worth the minor hassle of a phone call or an in-person visit, historically a deliberately friction-filled cancellation process that has drawn regulatory scrutiny and even lawsuits in several states, maximizes exactly the kind of low engagement, high retention membership base the model depends on. This is also precisely why low-cost gym chains have historically built their marketing and facility design around welcoming, non-intimidating environments for genuine beginners rather than serious athletes. Since a facility optimized to attract and retain a large population of infrequent, casual users generates dramatically more profit per square foot than one optimized to serve the smaller population of serious, frequent users who would actually use the facility close to its full physical capacity if everyone who paid for a membership genuinely showed up. The cost of actually building the thing. Opening a gym requires a meaningfully different capital investment depending on which of the four models discussed earlier you're pursuing, and understanding the specific cost structure explains why some segments of this industry have consolidated around a small number of large chains, while others remain genuinely fragmented among independent local owners. According to industry cost data tracked by fitness industry publications and franchise disclosure documents, opening a single low-cost, high-volume gym location commonly requires $1 million to $2.5 million in total startup investment, covering leasehold improvements to build out a typically large-format retail space, often 15,000 to 25,000 square feet, along with the cardio and strength equipment itself, which alone can represent $300,000 to $600,000 of that total depending on the specific equipment package and whether it's purchased outright or financed through equipment leasing arrangements. Common across the industry, a mid-market full-service gym with a broader amenity set, and particularly one including a swimming pool, represents a considerably larger investment, commonly $3 million to $8 million or more. Given the substantially higher construction and ongoing maintenance costs a pool specifically introduces, along with the additional square footage and specialized equipment a full-service facility requires to justify its higher membership price point. Boutique fitness studios, by contrast, typically require dramatically less upfront capital, often $150,000 to $500,000. Since a smaller physical footprint, commonly 2,000 to 4,000 square feet, combined with a more limited equipment package specific to the studio's particular specialty, keeps the total build-out cost considerably lower than either of the larger format gym models. A lower barrier to entry that explains why the boutique fitness segment has seen considerably more new independent entrants over the past decade than the higher capital, low-cost, and mid-market segments. Franchise fees represent an additional cost layer specific to the many gyms operated under a franchise structure, with initial franchise fees commonly running $20,000 to $50,000 depending on the specific brand and territory, on top of the actual facility build-out cost. In exchange for the brand recognition, training systems, and negotiated national supply and equipment relationships, the franchisor provides. The bill that never stops arriving. Running a gym involves a specific combination of fixed costs that arrive every month regardless of how many members actually walk through the door, a structural reality that makes this business genuinely similar to several other capital-intensive, fixed-cost businesses examined throughout this series. Despite its comparatively modest total capital requirement, rent represents consistently the single largest fixed cost for most gym operators. Since the large physical footprint this business requires, particularly for low-cost and mid-market models, means a gym's monthly rent obligation can run into the tens of thousands of dollars, even in a moderately priced commercial market. And unlike a retail store that might reasonably downsize its footprint during a difficult period, a gym's physical space requirement is relatively fixed by the equipment and layout the business model depends on, meaning rent doesn't meaningfully flex downward even during a membership downturn. Equipment financing represents a substantial, often underappreciated ongoing cost category, since much of a gym's cardio and strength equipment is commonly financed through multi-year equipment leases rather than purchased outright, meaning a gym's monthly equipment lease payments represent a genuine fixed obligation that continues regardless of membership levels. And equipment itself requires regular maintenance and periodic replacement as machines wear out from constant use. A maintenance cost that scales with the facility's actual usage in a way that partially offsets the otherwise favorable economics of low member engagement. Staffing costs vary considerably by gym model, with low-cost gyms typically operating with remarkably lean staffing, often just a small front desk and cleaning crew, given the minimal member-facing service the model provides, while mid-market and especially boutique studios carry considerably higher labor costs, since a boutique studio's entire value proposition depends on skilled, engaging instructors leading every class, meaning instructor compensation represents a much larger share of a boutique studio's total cost structure than equivalent staffing does for a low-cost gym. Utilities represent a genuinely significant and somewhat volatile cost category specific to this industry, since a gym's HVAC system runs continuously to manage the heat generated by both exercise equipment and members' own body heat during workouts. Along with the substantial water and heating costs a mid-market gym's pool or a boutique studio's showers require, costs that can fluctuate meaningfully with local energy prices, and that represent a genuine, non-negotiable expense regardless of membership levels. How the money actually comes back. Revenue models across these different gym categories reveal genuinely different underlying economics. And understanding these differences explains why the same gym label covers businesses with dramatically different profitability profiles. Low-cost gyms generate the overwhelming majority of their revenue from recurring monthly membership fees. And according to industry financial disclosures from publicly traded low-cost gym chains, the profitability of this model depends heavily on maximizing total membership count within a given facility's fixed cost structure, meaning a location's profitability is driven considerably more by successful membership sales and retention than by any per-visit revenue, since the marginal cost of an additional member who rarely visits is close to zero, while the marginal revenue from that same member's monthly fee flows almost entirely to profit. Mid-market gyms typically supplement base membership revenue with a broader set of ancillary revenue streams. Personal training sessions sold as an add-on service, group fitness class fees for premium offerings beyond what a basic membership includes, and pro shop merchandise sales. A revenue mix that requires more active member engagement to fully monetize, but that can generate meaningfully higher revenue per member than a pure, low-cost model achieves. Boutique studios depend most heavily on genuine, frequent member engagement, since their higher per-visit or per-month pricing acquires members to actually show up regularly enough to perceive real value in the premium price, making member retention and class attendance the central metrics the segment's operators track most closely. A fundamentally different relationship to member engagement than the low-cost model's dependence on exactly the opposite dynamic. Corporate wellness partnerships and health insurance subsidized membership programs, where employers or insurers subsidize or fully cover employee gym memberships as part of broader wellness initiatives, have become an increasingly significant revenue channel across multiple gym categories over the past decade, providing a genuinely different customer acquisition dynamic than direct-to-consumer marketing, since these partnerships can deliver a steady stream of new members through an employer or insurer relationship, rather than requiring the gym itself to shoulder the full cost of attracting each individual member. The volatility nobody wants to talk about behind the structural, fixed cost and engagement dynamics already discussed, gym ownership carries several distinctive, ongoing risks. Seasonal enrollment volatility represents a genuinely predictable, but still consequential risk specific to this industry. Since new member sign-ups spike dramatically every January around New Year's resolutions, before declining substantially through the following months, and a gym's entire annual sales and marketing calendar is built around capturing and converting this predictable but temporary surge. Meaning a weak January selling season, whether from poor local marketing execution or simply unfavorable broader economic conditions affecting discretionary spending, can meaningfully affect an entire year's membership trajectory in a way few other retail businesses experience with this same degree of calendar concentration. Consumer discretionary spending sensitivity affects this industry considerably. Since a gym membership, however modestly priced at the low-cost end of the market, remains a genuinely discretionary expense that financially stressed consumers cancel relatively easily and relatively early during periods of economic uncertainty, a dynamic that low-cost gyms are somewhat insulated from given their minimal price point, but that mid-market and especially boutique studios, with their considerably higher monthly cost, experience more severely during economic downturns. Real estate and lease risk represents a genuinely significant structural vulnerability specific to this business. Since gyms typically sign long-term commercial leases, often 10 years or more, to justify the substantial leasehold improvement investment required to build out the space, meaning a gym operator is committed to a fixed rent obligation for a decade, regardless of how membership trends actually develop over that period. A risk that becomes genuinely severe if a competing gym opens nearby, if the surrounding retail center loses foot traffic, or if broader economic conditions in the local market simply weaken over the lease term. And competitive saturation risk has become an increasingly significant concern, specific to the low-cost segment in particular, since the extraordinarily low barrier to membership switching. Given how little a member has actually invested in any specific gym relationship, means a new, better located or more aggressively priced competitor opening nearby can meaningfully erode an existing gym's membership base with relatively little the incumbent operator can do to prevent it, a dynamic that has driven genuine market saturation concerns in several metropolitan areas where multiple low-cost chains have expanded aggressively into overlapping territories. The real case study, 24. Our Fitness's bankruptcy. Understand how directly real estate and lease obligations can threaten even a large, well-established gym chain. Look at what happened to 24-Hour Fitness, once one of the largest gym chains in the United States, which filed for Chapter 11 bankruptcy protection in 2020. While the COVID-19 pandemic's forced closure of gyms nationwide represented the immediate trigger for the filing, since the chain's revenue collapsed essentially overnight when public health restrictions closed fitness facilities across the country for an extended period. The underlying vulnerability the pandemic exposed was substantially the chain's existing lease obligations across its large portfolio of locations, many carrying the kind of long-term, difficult-to-exit commercial leases common throughout this industry, obligations that continued accruing even while the company's actual revenue-generating operations were forced to shut down entirely. According to court filings and industry reporting on the bankruptcy proceedings, 24-Hour Fitness specifically used the Chapter 11 process to reject a substantial number of its existing leases, permanently closing more than 100 locations across the country as part of its reorganization, a legal mechanism that allowed the company to exit long-term lease obligations that would otherwise have continued, regardless of whether those specific locations were ever profitable enough to justify their rent, illustrating just how directly this industry's real estate commitments can become an existential liability once revenue is disrupted for any extended period, whether by a pandemic, a weak local economy, or simply years of gradually declining membership at a specific underperforming location. The company successfully emerged from bankruptcy with a smaller, more disciplined footprint and reduced lease obligations. continuing to operate as a private company with the considerably more conservative real estate profile than it carried into the crisis. A recovery that illustrates a genuinely important structural lesson specific to this industry, because a gym's core physical infrastructure, the building lease, the built-out equipment, represents such a substantial, multi-year fixed commitment relative to the business's actual month-to-month revenue predictability. The entire industry carries a structural vulnerability to any extended disruption of normal operations that has no clean parallel in a business with more flexible, shorter-term cost obligations, and 24-hour fitnesses bankruptcy, while triggered by an unprecedented pandemic, exposed a real estate commitment risk that had been quietly accumulating across the chain's expansion for years before the crisis actually forced the reckoning. Two scenarios. Let's build the honest math, the way an actual owner has to run it. In the good scenario, you own a well-run, disciplined, low-cost gym location in a genuinely underserved suburban market with limited nearby competition, having negotiated a favorable long-term lease at a reasonable rent relative to the local market, and you've successfully built a membership base large enough to comfortably exceed your facility's fixed costs through the classic breakage dynamic, where a healthy majority of your paying members rarely visit while continuing to pay their modest monthly fee. Your equipment financing is conservatively structured relative to your actual membership revenue, and your marketing spend efficiently captures the predictable January enrollment surge without overspending relative to what that seasonal cohort actually converts into long-term paying members. In a genuinely well-run location like this, low-cost gym operators can achieve location-level operating margins, commonly cited across industry financial disclosures, in the range of 20 to 30% of revenue. Figures that reflect just how favorable the breakage-driven economics of this specific model can be once a location reaches sufficient membership scale to comfortably cover its fixed rent and equipment costs. Now, the harder scenario. You own a similarly sized, low-cost gym location that opened just as a competing chain built a newer, better-equipped facility a few blocks away, triggering a meaningful membership exodus to the more modern competitor, while your own facility remains locked into a 10-year lease signed at a rent level that seemed entirely reasonable when you opened, but that your declining membership base can no longer comfortably support. Your equipment, aging and increasingly expensive to maintain relative to the newer competitor's facility, requires costly repairs and eventual replacement. Precisely at the moment your declining revenue makes that capital expenditure genuinely difficult to justify, and you find yourself managing a genuinely difficult, multi-year stretch where your fixed lease and equipment financing obligations remain constant while your membership revenue continues eroding, a structural bind with no easy exit, given the substantial penalty typically required to break a long-term commercial lease early. The gap between these two scenarios isn't a modest variance in a business plan. It's the difference between one of the most favorable operating margin businesses in small-scale consumer retail and a genuinely difficult, potentially loss-making trap, and which scenario a given gym falls into depends enormously on site selection, lease negotiation, discipline, and local competitive dynamics that were substantially determined before the gym ever opened its doors, rather than on the day-to-day operational excellence of running the facility itself. The real payoff, the difference between gym owners who build lasting, profitable businesses in this industry and those who end up trapped in an unprofitable, decade-long lease commitment, comes down to a small number of disciplined choices made almost entirely before the doors ever open. Securing a genuinely favorable long-term lease in a location with real, durable demand and limited near-term competitive risk matters more in this business than in almost any other consumer retail category examined throughout this series. Precisely because the multi-year lease commitment this business requires means a poor site selection or lease negotiation decision can't easily be corrected once the facility opens. Unlike a business with shorter lease terms or more flexible physical space requirements, understanding, with genuine clarity, which of the four gym models, low cost, mid-market, boutique, or franchise, actually matches your specific market and financial resources, rather than assuming any gym business operates under similar economics, has proven to be a critical distinguishing factor, since the breakage-dependent low-cost model and the engagement-dependent boutique model require genuinely opposite operational disciplines to execute successfully, and confusing the two, building a low-cost facility but trying to compete on service, or building a boutique studio but pricing it too low to sustain the instructor-driven experience. It depends on, has undermined more than one gym's economics from the very beginning, and maintaining conservative equipment and lease financing relative to a realistic, rather than optimistic, membership projection provides genuine protection against exactly the kind of structural bind that has forced gym chains, including major national names, into bankruptcy when membership growth failed to materialize as quickly or as durably as the original business plan assumed. The romance of the gym, the community of regulars, the genuine satisfaction of helping people build healthier habits, is entirely real. And it's precisely the operators who paired that romance with genuine discipline around site selection, lease terms, and a clear-eyed understanding of which specific gym business model they were actually running, who have built the kind of durable, profitable fitness businesses that the industry's most successful multi-location operators represent. Which means the honest answer to whether owning a gym can build genuine, lasting wealth is, yes, absolutely. For operators disciplined enough to treat this as the fixed cost, lease-dependent, model-specific business, it actually is. But the gym chains and independent owners who have gone bankrupt across this industry's history are a permanent reminder that the treadmill members skip isn't the only thing in this business that can quietly keep running up a bill long after anyone stopped paying close attention to it. And subscribe to my channel. Thank you.